Absolutely. Let's now go even deeper, step by step, in the simplest possible way, like I'm teaching someone who has never studied economics. I'll break everything into small pieces, use very simple words, and add more examples and extra explanations wherever needed. R1. What is depreciation? Simple meaning. Depreciation means that something, like a machine, vehicle, or tool, loses its value over time because it is being used or because it becomes old or outdated. Example. Imagine you buy a bike for your business. It costs $10,000. After 1 year, it's not new anymore. Maybe it's only worth $8,000. After 2 years, maybe it's worth $6,000. So every year, it loses value. This loss in value is called depreciation. 2. Why is depreciation important in accounting? Even if you don't spend any new money this year, your machine is still getting older. In your account books, you have to show that your machine is losing value. So accountants write it down every year. This is called accounting for depreciation. It's just writing down the loss of value. It does not mean you spent any money that year. 3. What actually happens in real life? Now think about the whole country, not just one business. There are thousands of businesses. Each business owns different machines. Some are new, some are old. Some businesses will have machines that are breaking or too old. They must replace those machines this year. So even if you didn't spend money on a new machine this year, some other business did. That means every year, some businesses are spending real money to buy new machines to replace the old ones. This is called replacement spending. 4. Why is this important? In the country's economy, accountants are writing depreciation in all the books. Value is going down. At the same time, businesses are really buying new machines. So the amount of real spending on new machines, replacement, is usually close to the depreciation amount written in the books. That's why we say depreciation, book loss, is usually matched by real-life replacement spending, buying new machines. Half 5. What does a country produce? Now let's talk about what a country actually makes. Every year, a country produces final goods. These are goods that are ready to be used. They fall into two big groups. A, consumer goods. These are for people to use. Examples: food, clothes, TVs, soap, bus rides. They make our life better. They are used up quickly. B, capital goods. These are used by businesses to make more goods. Examples: machines, trucks, tools, factory buildings. They are not for daily use. They help make more goods in the future. 6. Who buys these goods? People. Consumers buy consumer goods, but they can only buy them if they have money, which they get from earning income, from jobs, businesses, etc. So, more income, more buying of consumer goods. Businesses buy capital goods. They use them to replace old machines because of wear and tear, or to add new machines to grow and expand. What is the big idea? The trade-off. A country has limited resources, limited workers, limited raw materials, limited time, limited money. So the country must choose how to use these resources. If it uses more resources to make consumer goods, it will have less left to make capital goods. If it uses more resources to make capital goods, it will have less left to make consumer goods. This choice is called a trade-off. Example of the trade-off. Suppose the country has 100 workers. If 80 workers make food, clothes, and TVs, consumer goods, only 20 are left to make machines and tools, capital goods. But if the country wants to grow its future factories, it may decide 60 workers should make capital goods, so only 40 can make consumer goods. You can't do everything at the same time. You must choose. 8. Why does this trade-off matter? Because it affects how much people can consume today, consumer goods, and how much the country can produce in the future. Capital goods help future production. If we make more consumer goods today, people are happy now, but the country may grow slowly in future. More capital goods today. People may consume less now, but the country becomes richer in future. So the country must balance between today's needs and tomorrow's growth. Final summary. Like a story. Imagine a country is like a big family. Every year, the family makes and uses things. It uses some things for daily life, food, clothes, consumer goods. It also needs tools and machines, like sewing machines, ovens, capital goods to keep producing. Some tools get old, they depreciate. Even if no one buys a new one this year, they write down in the notebook that it lost value. But across many families, some are always buying new tools every year, so the real spending matches the written down loss. The family must decide, should we spend more on food now or buy new tools to make more food later? This is the trade-off. Spend for now, consumer goods, or invest for future, capital goods. Every economy faces this choice every year. Would you like me to draw a chart, a table, or a simple comic-style picture to explain this visually? Let me explain this in the most simple, clear, and step-by-step way, like teaching a total beginner or a child. I'll go word by word, line by line, with extra examples and deep but easy to understand explanation. Original sentence 1. It is generally observed that more sophisticated and heavy capital goods raise the ability of a laborer to produce goods. Simple meaning. People have noticed this again and again. When workers use better, stronger, and more advanced machines, they can make more things and work faster and better. Word-by-word breakdown. It is generally observed. People often see/notice this. More sophisticated and heavy capital goods. Fancy or powerful machines, tools, or equipment. Capital goods means tools and machines used to make other goods. Sophisticated equals advanced, modern, heavy, big and strong, like factory machine. Raise the ability of a laborer, help the worker do more, faster, and better. To produce goods, to make products like clothes, buildings, food, etc. Example. Imagine two tailors. One, old-style tailor, uses a hand needle and thread, takes 2 days to one shirt. Two, modern tailor, uses an electric sewing machine, makes 10 shirts in 1 day. The modern sewing machine, capital good, helps the tailor work much faster and make more goods. Original sentence 2. The traditional weaver would take months to weave a sari, but with modern machinery, thousands of pieces of clothing are produced in a day. Simple meaning. In the old days, a weaver took a long time to make one sari by hand. But today, with big weaving machines, factories can make thousands of clothes in just 1 day. Word-by-word breakdown. The traditional weaver, an old-style worker who weaves cloth by hand, would take months to weave a sari. It took a long time to make one sari, maybe 1 or 2 months. But with modern machinery, now using machines in factories, thousands of pieces of clothing are produced in a day. Factories make a huge amount of clothes very quickly. Example. One old weaver using a hand loom makes one sari in 1 month. One modern factory makes 5,000 saris in 1 day. Because machines are faster and don't get tired. Original sentence 3. Decades were taken to construct the great historical monuments like the pyramids or the Taj Mahal. But with modern construction machinery, one can build a skyscraper in a few years. Simple meaning. Long ago, it took many years or decades, 10, 20, 30 years or more, to build big things like the pyramids or the Taj Mahal using only human labor But today, with modern construction machines, we can build huge skyscrapers in just a few years. Decades were taken to construct, took tens of years to build, great historical monuments like the pyramids or the Taj Mahal. Famous buildings from long ago that were built with hard labor but with modern construction machinery. But now we have big machines, cranes, diggers, trucks, etc. One can build a skyscraper in a few years. Now we can build very tall buildings very quickly. Example, Taj Mahal took about 22 years to build, with thousands of workers using hand tools. Burj Khalifa, world's tallest building, in about 6 years. Modern machines. Modern machines equals faster, safer, stronger, and more efficient. Original sentence 4. More production of newer varieties of capital goods, therefore would help in the greater production of consumer goods. Simple meaning. If we make more and better machines, capital goods, then we can also make more products for people to use, consumer goods. Word by word breakdown. More production, making more things of newer varieties of capital goods, making newer, better types of machines and tools, would help in the greater production, would make it easier to make more of consumer goods, things that people use every day, food, clothes, phones, etc. Example, if we make more tractors and better tools for farming, then farmers can grow more rice, wheat, and vegetables. If we make more sewing machines, then workers can make more shirts and dresses. Better tools, more production, more goods for people. Final summary. Imagine two worlds. Old world, people make things by hand. A sari takes a month to make. A monument takes decades to build. Tools are simple and slow. Modern world, people use big machines. A machine weaves thousands of saris a day. Skyscrapers go up in just a few years. Machines do hard and fast work. The big idea. If we build more and better machines, capital goods, then people can make more clothes, more food, more buildings, consumer goods, faster, cheaper, and better. Would you like a comic-style picture for this idea too? I can make it visual for even easier understanding. Absolutely. Let's now go even deeper, but in the simplest way possible. Like teach someone with zero background. I'll go line by line, word by word, explaining it like a story, using examples, comparisons, and no difficult word. This will be the most detailed and clear explanation possible. The main idea. We are talking about how an economy grows by making capital goods like machines, tools, buildings. Even though making machines now means fewer goods for people right now, those machines help us make more things later. So it's not a contradiction. It's just about timing. Let's go step by step. 1. But aren't we contradicting ourselves? Simple meaning. Are we saying two things that don't make sense together? Earlier we said, if we make more capital goods, we make fewer consumer goods. Now we say, making more capital goods helps us make more consumer goods. That sounds confusing, right? But don't worry, it's not a contradiction. The answer is in the next lines. There is no contradiction here, however. What is important here is the element of time. Simple meaning. These two statements are not fighting each other. We just need to think about when things happen. It's all about time. Now, short term, versus later, long term. Let's see an example. Example to understand time difference. Imagine you are a poor village carpenter. You have the layer 1000. You can use it to buy food now, consumer good, or buy a tool like an electric drill, capital good. If you buy food, you eat well today, but have nothing left for tomorrow. If you buy the drill, you may have to eat simple food today, but they're faster. You can sell more, earn more, and buy more food later. So buying the drill reduces your comfort today, but gives you more comfort in the future. Hamj 3. At a particular period, given a level of total output of the economy, it is true, if more capital goods are produced, less of consumer goods would be produced. Let's break it down. At a particular period, at one time, for example, this year, given a level of total output, equals the economy can only make a certain amount of stuff. If more capital goods are produced, if we make more machines, less of consumer goods would be produced. We can't make as many clothes, food, phones, etc. Simple meaning. In 1 year, if we decide to use more factories and workers to make machines, we will have fewer resources left to make things people use every day. Example. A toy factory has 10 workers. If all 10 workers make toys, 100 toys per day. If 5 workers build new machines, only 5 are left to make toys, so only 50 toys per day. So more capital goods, machines, less consumer goods, toy, now. But production of more capital goods would mean that in future, the laborers would have more capital equipments to work with. Simple meaning. If we make more machines today, tomorrow our workers will have better tools to do their job. They'll work faster, smarter, more powerfully. Example, without a sewing machine, 1 shirt per day. With a sewing machine, 10 shirts per day. Making the sewing machine today means you can make 10x more tomorrow. 5. We have seen that this leads to a higher capacity of the economy to produce with the same number of laborers. Simple meaning, even if the number of workers stays the same, their output, the things they make, goes up because they are using better tools. So the total power of the economy becomes bigger. SHA-6. Thus, total input itself would be higher compared to the case when less capital goods were produced. Let's simplify. Total input equals all the tools, machines, and effort used to produce things. If we made more capital goods earlier, we now have more powerful machines to work with. So the economy becomes stronger. It's like adding muscles to the economy. Hack 7. If total output is higher, the amount of consumer goods that can be produced would surely be higher. Simple meaning, if the economy produces more things in total, then of course it can also make more goods for people to use. So yes, even though we made less consumer goods earlier, we will be able to make a lot more later. 8. Thus, the economic cycle not only rolls on, higher production of capital goods enables the economy to expand. Simple meaning, the economy keeps moving forward in a circle. People work, they earn money, they spend it. Businesses earn money, they make machines, machines help workers, workers make more stuff. This circle keeps spinning. And every time we add capital goods, like machines, this circle becomes bigger and stronger. The economy grows. 9. It is possible to find another view of the circular flow in the discussion we have made so far. Simple meaning, we can now understand the economy as a circle that moves. People get jobs, earn money, buy goods. Businesses sell goods, get money, buy machines. Machines help people work better, make more goods. This makes more income and more spending and more growth. This is called the circular flow of the economy. But now we see how capital goods make the circle grow bigger and faster over time. Final ultra-simple summary. Here's the full idea in a story. You can make machines, capital goods, or things people use, consumer goods. If you make more machines today, you'll have fewer things for people now. But tomorrow, the machines will help you make more things faster. So, in the future, people get more goods and the economy becomes stronger. It's like planting seeds today to get a big harvest tomorrow. No contradiction, just about short-term pain, long-term gain. Would you like a comic-style picture to show this with workers, machines, and growth over time? I can make that for you too. Absolutely. Let's now explain this in the most simple, slow, step-by-step way, like teaching a complete beginner. I'll explain word by word, line by line, with very easy examples, clear meanings, and extra details wherever needed. Full passage, broken down. Depreciation does not take into account unexpected or sudden destruction or disuse of capital, as can happen with accidents, natural calamities, or other such extraneous circumstances. Word by word explanation. Depreciation. This means loss in value of something over time, especially machines, tools, or buildings, called capital. Example, a new car becomes old each year. Its value drops. That's depreciation. Does not take into account. This means does not include or does not consider. Unexpected or sudden. Things that happen without warning, very quickly. Destruction or disuse. Destruction, when something is broken or ruined. Disuse, when something is not used anymore. Capital, big things used to produce other things, like machines, buildings, tools. As can happen with accidents, natural calamities. Accidents equals car crashes, factory fires. Natural calamities equals earthquakes, floods, cyclones, etc. Other such extraneous circumstances. Extraneous means outside our control. Circumstances means situations or events. Simple meaning of this line. Depreciation does not include sudden damage to machines or buildings caused by accidental disasters or other unexpected events. It's slow wear and tear. We are making a rather simple assumption here, that there is a constant rate of depreciation based on the original value of the asset. Word by word explanation. We are making a simple assumption. We are choosing to believe something just to make calculations easier. Constant rate of depreciation. This means the machine or asset loses amount of value every year. If a machine loses 1,000 of value every year, that's constant depreciation. Based on the original value, the amount we subtract each year is based on how much the thing cost when it was new. Asset, any valuable thing, like a machine, truck, building, etc. Simple meaning of this line: we are assuming that the machine or building loses the same amount of value every year based on how much it originally cost when new. Example to make it clear. Let's say a machine costs $10,000 when new. We assume it will lose 1,000 value every year for 10 years. After 1 year, value equals 9,000. After 2 years, value equals 8,000. After 10 years, value equals 0. This is constant depreciation, but this method ignores accidents. If the machine breaks in a flood in year 3, depreciation still says it's worth 7,000, but actually, it's totally destroyed. So depreciation doesn't always match real life. There can be other methods to calculate depreciation in actual practice. Word-by-word explanation. Other methods, different ways or systems, to calculate depreciation to figure out how much value is lost each year. In actual practice, in real life, companies may use more complex methods. Simple meaning of this line. In real life, businesses and accountants don't always use this simple method. There are other ways to calculate how fast machines or buildings lose value. Real life example. Some businesses use straight line method, same amount of loss every year, like our example above. Declining balance method. The machine loses more value in early years and less later. Usage-based method. Value goes down based on how much it's used, like a car losing value based on how many kilometers it runs. Final ultra-simple summary. Depreciation equals slow and regular loss of value in machines, buildings, etc., but it doesn't count sudden damage from things like floods or accidents. We often assume the machine loses the same value every year, called constant depreciation. This makes things easier to calculate, but it's just a guess. In real life, people use other, more accurate methods too. Would you like a comic-style picture showing a machine getting older and damaged, with and without accidents, to make this even clearer? I can make that too. Absolutely. Let's now go even deeper, step by step, in the most detailed and easiest way possible. Like I'm explaining to someone with no knowledge at all. I'll go word by word, sentence by sentence, and use very clear examples and simple logic to help you truly understand it better than ever before. Main idea. We are talking about how money moves in a circle between people and businesses in the economy. And we are also talking about how people can only buy things if they have money, income. And they get this income by offering their work, land, money, or business skills. Let's begin. One piece at a time. Sentence 1. Since we are dealing with all goods and services that are produced for the market, the crucial factor enabling such sale is demand for such products backed by purchasing power. Meaning word by word, since we are talking about goods and services produced for the market. These are things people make, goods or do, services to sell them for money. Example, a car, a TV, clothes, goods. Haircut, delivery, teaching, services. Crucial factor enabling such sale. The most important thing that allows people to buy these goods and services is demand backed by purchasing power. It's not enough to want something. You also need to have the money to buy it. Simple summary. You can only buy things in the market if, 1, you want it, 2, you have the money to buy it. Just wanting food is not enough. If you don't have money, you can't buy it. The market won't respond to you. Example. A boy is very hungry but has no money. The shopkeeper cannot give food because he cannot pay. Another boy has money and is hungry. He buys food from the shop. So the market listens to money, not just needs. Sentence 2. One must have the necessary ability to purchase commodities. Otherwise, one's need for commodities does not get recognized by the market. Word by word. Ability to purchase commodities equals you need money to buy things. Commodities equals goods or products like food, water, shoes, mobile phones. Otherwise, if you don't have this ability, The market does not recognize your need. Even if you need something badly, the market ignores you if you don't have money. Simple summary. No money equals no purchase equals no help from the market. The market only works when people can pay. Sentence 3. We have already discussed above that one's ability to buy commodities comes from the income one earns. Now we talk about how people get money. You can get income by doing one of these 4 things. 1. Laborer. Wages. You work for someone. Example, a cleaner earns $500 a day. This is called wage. 2. Entrepreneur. Profits. You run a business. Example, you sell samosas and earn $300 profit per day. 3. Landlord. Rent. You own land or a house and give it to someone to use. Example, you rent out your shop and get 10,000 pak a month. 4. Owner of capital. Interest. You lend money or give machines, tools to others. Example, you give 100,000 to someone and get 5,000 as interest. Sentence 4. In short, the incomes that people earn as owners of factors of production are used by them to meet their demand for goods and services. Let's simplify. People get income by working, labor, giving land, using money, tools, capital, running businesses, entrepreneurship. They spend that income to buy things for themselves. Super simple meaning. People earn money by offering something to production. Then they use this money to buy things they want or need. Sentence 5. So we can see a circular flow here, which is facilitated through the market. Circular flow equals a circle where money goes around. Facilitated through the market. This circle happens through buying and selling in the market. Super simple meaning. People earn money, spend it in the market. That money goes to companies. Companies again pay people. Money goes around and around, like a wheel turning. Sentence 6. Simply put, the firm's demand for factors of production to run the production process creates payments to the public. Let's break it down. Firms equal companies or businesses. Factors of production equals what is needed to produce things. Labor, workers, land, capital, money, machines. Entrepreneurship, skill to run a business. Firms demand these to make goods. When they take these, they must pay the people who gave them. Simple meaning. Businesses hire workers, rent land, use money and machines. They pay the people who give these things. Sentence 7. In turn, the public's demand for goods and services creates payments to the firms and enables the sale of the products they produce. Let's break it down. People, public, use the money they earn to buy clothes, food, phones, etc. This money now goes to the businesses, so the businesses get paid for the goods they made. Simple meaning. People buy goods, companies earn money, and the circle continues. Final super easy summary. Let's think of this like a simple circle. 1. Companies need workers, land, money, so they pay people to get these. 2. People now have money, income. 3. People buy things, food, clothes, etc. from companies. 4. Companies earn money and again pay people to make more goods. This is called the circular flow of income. It keeps the economy running like a moving wheel. Would you like a comic-style visual for this circle? I can create a cartoon where a company pays a worker. The worker buys groceries. The shop earns money and pays its worker. That worker buys something else, and the money keeps going in a circle. Just say yes, and I'll create it. Here's a great, deep, and detailed summary of everything we've explained in the simplest language with extra clarity, so even a total beginner can fully understand. The big idea. The economy works in a circle. The economy is like a circle where money, goods, and services keep moving between 2 main groups. 1. Firms, businesses. They make products and pay people to help them. People, public, they earn money from businesses and then buy products from them. This circle goes on and on. That's why we call it the circular flow. Step-by-step breakdown. 1. Businesses need resources to make things. To produce cars, businesses need land to build factories, labor, people to work, capital, machines, tools, entrepreneurs, the people with ideas and plans. Businesses pay for these things, wages to workers, rent for land, interest for borrowed capital, profit for the entrepreneur. This is called factor payments, money given to people who provide the inputs. 2. People use their income to buy goods and services. People use the money they earn, like clothes, mobile phones, tickets for movies, school books. This spending gives money back to businesses. 3. Businesses sell what they produce. The goal of production is to sell products and earn income. So businesses depend on people to buy their goods. The money that comes back from people's purchases lets firms pay wages, buy materials, and make more goods. 4. This creates a continuous circle. Businesses pay people, people buy goods, businesses get paid, and again, this loop keeps the economy alive and moving. 5. Capital goods also play a key role. Some firms make capital goods, like machines, tools, buildings. These goods are not for immediate use, but they help make other goods. Example, a tractor is a capital good. It helps grow crops, but people don't eat the tractor. They eat the wheat it helps produce. The production of capital goods also gives wages, profits, etc., adds to the economy's capital stock, its tools for the future, allows more production of goods in future years. 6. Time makes a difference. In the short term, if more capital goods are made, fewer consumer goods like food or clothes are available now. But in the long term, having more capital goods means more production capacity. More machines, more products, more jobs, more income. So we sacrifice a bit now to gain more later. That's how the economy grows over time. Final summary. The economy is like a circle of money and goods. Businesses give money to people for helping in production. People use that money to buy goods and services. Businesses get that money and make more products. Some businesses make capital goods that help us make even more things in the future. This circle keeps the economy running, growing, and improving. It's a beautiful loop where production, income, spending, and more production keep feeding into each other. If you'd like, I can also draw this summary into a visual cartoon-style flowchart or infographic. Would you like me to do that? Sure. Here's a clear and detailed summary of what we learned so far, explained like you're learning it for the first time. Summary: circular flow of income in a simple economy. What is a simple economy? A simple economy has just two main parts. 1. Households, people or families. 2. Firms, businesses or companies. In this simple economy, there is no government, no taxes or government spending. There is no foreign trade, no buying or selling with other countries. There are no savings. People spend all the money they earn. Who does what? Households, people. They give their money, ideas, or land to firms. These are called their contributions to production. Firms, businesses. They use what households give to produce goods and services. They pay households for their contributions. The 4 types of contributions from households to firms. Contribution type, what it means, reward, payment in managing a business, labor, working with hands or brain, wage, capital, giving money, tools, or machines, interest, entrepreneurship, starting and managing a business, taking risk, profit, land, natural resource, allowing use of land or space. How does the money flow in a circle? The circular flow. It works like a loop or circle. 1. Households give labor, capital, land, and entrepreneurship to firms. 2. Firms use these things to produce goods and services. 3. Firms pay households, wages for labor, interest for capital, rent for land, profit for entrepreneurship. 4. Households use this money to buy goods and services from firms. And 5. Firms get money again, and the cycle starts over. This never-ending cycle is called the circular flow of income. Easy example. Let's imagine a small village. Ram works in a rice mill. He gets wages. Sita gives money to a shop. She gets interest. Gopal gives land to a bakery. He gets rent. Priya starts a fruit stall. She earns profit. They all spend their earnings in the village market. buying food, clothes, and services. That money goes to businesses, and the businesses again pay workers, landowners, investors, and business owners. So, money keeps moving in a circle, from people to businesses and back to people. Why is this important? This circular flow shows how money moves through the economy. Everyone is connected. Workers, businesses, owners, buyers, all parts of the economy depend on each other. This also helps us understand how to measure a country's total income, which leads to the topic of national income. We'll explain that next if you want. Let me know if you'd like a simple, clear explanation of how national income is calculated in the same beginner-friendly, step-by-step way. Absolutely. Let's now explain everything even more deeply, step by step, using the simplest language possible, like you're learning it from the best teacher ever, with full clarity and examples. We'll go line by line, word by word, breaking each idea into tiny, clear pieces. Main topic, circular flow of income in a simple economy. Let's imagine a small, closed village. No government, no foreign trade. No one saves money. Only people and businesses exist. Step 1. Who are the main players? In this simple economy, we only have 1. Households. These are the people or families who live in the economy. 2. Firms. These are the businesses that produce goods and services. Step 2. What do households do? Households provide the things firms need to make products. These are called factors of production. There are 4. Factor of production, what it means, what they get paid, living space, water, minerals. Labor, people working, e.g. farmers, tailors. Wage, giving money, tools, machines. Interest, giving space, soil, water, minerals. Rent, entrepreneurship, running businesses, taking risks, profit. So, households earn money by giving these things to firms. Step 3. What do firms do? Firms take the land, labor, capital, and entrepreneurship and use them to make goods and services, like clothes, bread, transport, haircuts, soap, and more. Then firms sell these things to households, the people. Step 4. What do households do with the money? In this basic, simple economy, households spend all the money they earned. They don't save any of it. They don't pay taxes because there's no government. They don't buy things from other countries because there is no foreign trade. They use all their income to buy goods and services from the same firms that paid them earlier. Step 5. What happens to the money then? Let's follow the money like a circle. 1. Firms pay money to people for their work, land, capital, and ideas. 2. People spend that money to buy things from the same firms. 3. The money goes back to the firms. 4. Firms, again, pay people with that money. So, the money keeps moving in a circle. It never leaves the system. Important word. Leakage means money going out of the circular flow. For example, if someone saves money, it's not spent. If someone pays tax, it goes to the government. If someone buys imported goods, money goes to another country. But in this simple economy, no savings, no taxes, no foreign goods. So, no leakage happens. All money stays in the system. Key idea. Total income equals total spending, total sales. Let's say the total income of all people in the village is 1,000. They spend all 1,000 buying goods from the shops. So the shops, firms, get 1,000 in revenue, sales money. That means total income earned by people equals 1,000. Total money spent by people equals 1,000. Total money earned by firms from sales, they are all equal. Ultra simple example. Let's imagine a village with just 2 people and 1 shop. Mina works at a sweet shop. She earns 500 in wages. She spends all 500 to buy sweets from the same shop. So the shop pays her 500 income for Mina. Mina spends 500 at the shop, income for the shop. This is a complete circle. The money goes out of the shop into Mina's hands and then comes back to the shop. No money is lost. Why is this important? This model teaches us how income moves in an economy, how everyone depends on each other. That, in a perfect simple system, no money is wasted or lost. It also helps us learn how to measure national income, which we'll explain later. Final summary, like a child's story. Imagine a village where people help businesses make things. Businesses pay people money. People use that money to buy things from businesses. Businesses get the money back and pay people again. And the cycle continues, round and round, like a wheel. This is called the circular flow of income. No savings, no taxes, no foreign trade. Just a perfect circle of giving, earning, and spending. Would you like me to now explain what leakages and injections are, like savings, taxes, exports, etc., and how they change the circular flow, again, in the simplest possible way? Here is detailed and very simple summary of what you just read, like the world's best teacher explaining to someone with zero background. Summary of circular flow of income in a simple economy, without government or foreign trade. What is this about? This is about how money flows in a very simple economy. An economy with no government, so no taxes, no foreign trade, so no imports or exports, no savings. People spend everything they earn. In this economy, there are only two main groups. One, the people who work and own things. Two, firms, the businesses that make goods and services. Hash step-by-step flow of money in the simplest form. 1. Firms produce goods and services. Example, a bakery makes bread. A carpenter makes furniture. 2. To produce, firms need help from households. They need labor, workers, get paid wages. Land, space, natural resources, get rent. Capital, tools, machines, money, get interest. Entrepreneurship, business mind, risk taker, gets profit. 3. Firms pay money to households for providing these things. This money is called factor payments or remuneration. So households earn income. 4. Households spend all their income to buy the goods and services made by the firms. Workers buy bread and furniture. Everyone spends all the money they earned. 5. Firms receive this money as sales revenue from selling goods services. 6. This same money is again used by firms to pay households, and the cycle repeats every year. What does this mean? The same money goes around in a circle, from firms to households as wages, rent, etc., from households to firms as spending. This is called the circular flow of income. Important points. There is no leakage in this economy. Leakage means money leaving the circle, like savings, taxes, or imports. But in this simple model, people don't save, don't pay taxes, and don't buy from other countries. So, all the money stays in the system. The total income of all households, the total spending equals the total value of goods produced. So, we can measure national income in 3 ways. All give the same answer in this simple model. 1. Income method. Add all the income people earned, wages, rent, interest, profit. 2. Expenditure method. Add all the money people spent. 3. Production method. Add the total value of goods, services made by firms. Very simple example. Imagine a toy economy. There's one firm, a bakery. It pays 100 to workers and the landowner. These people use the 100 to buy bread from the bakery. The bakery earns 100 again and pays it to workers next month. And this goes on and on. So the same 100 keeps moving in a perfect circle. Big picture. In this very basic economy, money flows like a wheel. No part of it leaks out. Every rupee spent becomes someone's income. That income is then spent again. This endless circular flow keeps the economy moving. This idea helps economists understand how production, income, and spending are all connected, and how you can measure the total economic activity using any of these. Would you like a visual diagram or cartoon-style drawing of this flow too? I can make it super clear. Sure. Let's dive even deeper into this idea with very clear, simple words and lots of examples so you understand every part fully. I'll explain why these arrows are important, what they represent exactly, and how this whole system works together in the economy. Detailed explanation of the circular flow diagram, figure 2.1. 2 big parts, households and firms. Households. These are all the people. You, me, families, firms. These are all businesses, shops, factories, service providers. Everything happens between these two groups in this simple economy. Two types of markets in a diagram shows two markets where exchanges happen. Goods and services market, top two arrows. Factors of production market, bottom two arrows. 3. Goods and services market, top arrows. What is this? It is the place where firms sell goods and services to households. Example, a shop sells clothes, a restaurant sells food, a barber gives haircuts. How do the arrows work? Arrow from households to firms. This is money spent by people to buy things. Example, you pay $50 to buy bread. Arrow from firms to households. This is the goods or services that people get. Example, the bakery gives you bread. Why is this important? It shows that people use their money to get things they want or need. Firms get money to keep running their business and pay their workers. 4. Factors of production market, bottom arrows. What is this? This market shows how households provide resources, called factors of production, to firms to make goods and services. Factors of production include labor, people's work or effort, land, natural things like land, water, minerals, capital, machines, tools, money used for business. Entrepreneurship, people who organize and take risks in business. How do the arrows work? Arrow from households to firms. This shows people giving their services to firms. Example, a tailor works in a shop, labor. A farmer rents land to a factory, land. Or someone invests money to buy machines, capital. Arrow from firms to households. This shows firms paying households for these services. Examples of payments: wages for workers, rent for land, interest for capital, profit for entrepreneurs. Why is this important? This arrow pair shows how households earn money. Firms need these factors to produce goods and services. Without these services, firms can't make anything. 5. The full circular flow. Now put these two markets together, and here's what happens. Households give factors of production, work, land, money, to firms. Firms pay households for these factors. Households use this money to buy goods and services from firms. Firms sell goods and services and get money. Firms use the money to pay households again. This cycle keeps going round and round like a circle. Number 6. Why is this circular flow important? It shows how money moves in the economy. It shows how goods, services, and money flow continuously between households and firms. It helps us understand that production, income, and spending are all connected. If one part stops, like if households stop spending, the whole flow slows down, meaning businesses sell less and pay less, and the economy suffers. Number 7. Extra examples to understand. Imagine a small village. Farmer, household, works on the land. The farmer sells vegetables to the local store, firm. The store sells vegetables to families, households. Families pay money to the store. The store pays the farmer for the vegetables. The farmer uses that money to buy clothes made by a tailor. The tailor works in a small business and pays the workers. This shows the circle keeps flowing smoothly. 8. What if something breaks the flow? If households decide to save money instead of spending, or if they pay taxes, money goes to government, not firms, or if they buy imported goods, money goes out of the country, then the circular flow is not perfect anymore. Money leaves the system. This is called a leakage and can slow down the economy. 9. Summary of key terms. Term meaning, example. Households, people who work, own land, money, ideas. You, your family. Firms, businesses that make goods and services. Shops, factories, goods and services market, where goods and services are bought and sold. Buying bread, clothes, factors of production market, where labor, land, capital, entrepreneurship are provided and paid for. Working in a factory, renting land. Factor payments, money paid for labor, land, capital, entrepreneurship. Wages, rent, interest, profit. Circular flow, continuous movement of money and goods between households and firms. Money flows like a circle. If you want, I can explain any part again, or give real-world examples for better understanding. Absolutely. Here's a great, deeply detailed summary of the full concept we just discussed, written in the simplest, clearest way possible, like teaching a total beginner or a child. Topic: circular flow of calculating national income. What is the circular flow of income? The economy works like a circle where money keeps moving between two main groups. Households, the people; firms, the businesses. Households give their services to firms, like working in a factory, renting land, investing money, or starting businesses. In return, firms pay households wages for labor, rent for land, interest for capital, profit for entrepreneurship. Households then spend that money to buy goods and services like clothes, electricity, and transport. That same money comes back to the firms as revenue, sales income. The firms again use this money to pay the households for their work, and the cycle repeats. This never-ending loop is called the circular flow of income. Why is this important? This circular flow helps us understand how money moves in the economy, how everything is connected: income, spending, and production. Because it's the same money flowing in a circle, we can measure the total income of the economy, called national income, at any point in the circle. 3 methods to measure national income. We can measure national income in 3 different ways, depending on where we look in the flow. 1. Expenditure method. Count all the money people spend. We look at the top part of the circle, where households buy goods and services. This method is spending on final goods and services in the economy. Example: a family buys a fridge and a movie. Every household in the country does the same. We add up all this spending equals national income. Expenditure method. 2. Product method. Count all the goods and services produced. We look at the middle of the circle, where firms are producing goods and services. This method adds up the total value of everything made by businesses. Final goods only, not raw materials. Example: a factory makes cars, a farm grows rice, a school gives education. We calculate the money value of all these final products. Add everything equals national income. Product method. 3. Income method. Count all the money people earn. We look at the bottom of the circle, where firms pay households. This method adds up all the incomes that people earn from working or owning land, capital, or businesses. Example: worker earns salary, landlord earns rent, investor gets interest, businessman gets profit. We add up all these earnings equals national income. Income method. Do all methods give the same result? Yes, because the money that people spend becomes the sales revenue for businesses. The value of goods produced equals the value of goods sold. The money businesses receive is used to pay incomes to people. So all 3 are just different sides of the same coin. It's the same money measured from different angles. Visual image in words. Imagine a big circle. At the top, money goes from people to shops, spending. At the middles, goods and services are made and sold, production. At the bottom, money goes from businesses to people, income. This circle keeps going, year after year. Final summary. The circular flow of income shows how money moves between people and businesses. People work and earn income. They spend that income to buy goods. Businesses use the money they earn to pay incomes again. Because money moves in a full circle, we can measure a country's total income, national income, in 3 ways. By counting what people spend, expenditure method; what businesses produce, product method; or what people earn, income method. All 3 methods show the same total because they are part of the same money cycle. Let me know if you'd like a diagram of this process, a comparison table of the 3 methods, a practice worksheet or quiz to test your understanding.